Why would anyone pay 100 times a company's earnings for a single share of stock? It seems irrational, doesn't it? But what if I told you that efficient market theory has a perfectly logical explanation? Today, we're diving deep into why price to earnings ratios vary so dramatically across stocks, and how understanding this can make you a more sophisticated investor. Let's start with a fundamental principle that every serious investor should understand. The cornerstone of equity valuation is surprisingly simple. A stock's price should equal the present discounted value of all its future expected dividends. This gives us the famous Gordon growth model, where P equals price, D1 is next year's expected dividend. R represents the required rate of return, reflecting the investment's risk, and G is the constant growth rate of those dividends. But here's where it gets interesting. When we rearrange this formula, we get P over E equals 1 over R minus G. This simple equation explains everything about PE ratio variations. Efficient market theory tells us that prices already reflect all available information, but that doesn't mean all stocks should have the same PE ratio. Consider Tesla during its explosive growth phase. The stock often traded at PE ratios exceeding 100. Investors weren't being irrational, they were betting on revolutionary growth in electric vehicles, energy storage, and autonomous driving. A high expected growth rate in our formula means investors will pay much more per dollar of current earnings. This principle applies to any high growth company. Young software firms, biotech companies, developing breakthrough drugs. Even if current earnings are modest, but the present value of potentially massive future dividends justifies today's high price. It's the magic of compound growth expectations. But growth is just one piece of the puzzle. The other critical factor is risk, and this is where things get really interesting. Compare a stable utility company like Consolidated Edison with an emerging biotech firm. The utility has regulated business, predictable cash flows, minimal risk. The biotech faces drug development failure, regulatory hurdles, intense competition. Investors demand a higher rate of return to compensate for this uncertainty. A higher discount rate in our formula means a lower PE ratio, even with identical growth prospects. So even promising biotech companies might trade at lower PE ratios than boring utilities. It's all about the risk-adjusted return investors require. This is often measured by beta, which captures how much a stock moves relative to the overall market. But there's another factor that sophisticated investors always consider: the actual cash that companies return to shareholders through dividends. Dividend yield shows how much cash you actually receive relative to your investment. A stable utility might yield 4%, a growth tech company 1%, a REIT 10%. For income-seeking investors, this metric is crucial, but beware of yields that seem too good to be true. A 20% yield might signal a company in financial distress. The high yield could be due to a collapsed stock price, and that dividend might disappear entirely. Consider Apple versus Alphabet. Apple pays regular dividends, while Alphabet historically reinvested earnings for growth and share buybacks. Investors seeking immediate income might prefer Apple's approach, but dividend yield shouldn't be your only consideration. You must analyze the company's financial health, growth prospects, and dividend sustainability. This brings us to the bigger picture of market efficiency. The market, in its collective wisdom, prices every stock based on these fundamental factors. Growth expectations, risk assessment, and dividend policies all interact to determine PE ratios. Understanding these relationships makes you a more sophisticated investor. You'll never again wonder why some stocks trade at sky-high PE ratios. Instead, you'll recognize the market's rational assessment of future potential. Armed with this knowledge, you can make more informed investment decisions and build long-term wealth with confidence.